Hey everybody, Smart Silver Stacker here. Hope you're doing well. So the price of gold has hit a new record high, but this party is just getting started, and so is the collapse of the US and global economy. We're going to talk about what this new record price for gold means for the precious metals, where the price is going to be heading from here, what catalyzed this move, and all of the fallout that I believe we will see. So do me a favor, if you're joining the live stream, welcome. Put a 1 in the chat. Let me know you can hear me loud and clear, and smash that like button to help get this information out into the algorithm. So here's the headline from Reuters. Gold hits record high on bets for March start to Fed rate cuts. And so markets are beginning to price in an easing of Fed policy. And this kind of runs contrary to what we heard from Fed Chairman Jerome Powell today. He had a speech. He told us that it was premature to begin easing and that the Fed actually was prepared to tighten further. But he did talk a lot about how the balance of risks was now more in balance and that the balance of over-tightening was being matched by the risk of under-tightening. And so the market reaction to this commentary from Powell, well, it was to send gold to a new record high. So we're looking at the weekly chart here of gold, and you can see we do have this very nice cup and handle pattern forming here. And now we have actually moved above this trend line here. We're not above 2100 yet, but we are at the highest daily close for silver or rather gold. We'll talk about silver in just a moment. Let's talk about gold real quick. I want to zoom into the daily chart here, and you can see that we closed at, what did we close at today? $2,071. And this actually is just below previous intraday highs that we had seen earlier in May when gold got up above $2,080. But this is a closing price at a new high. And this is very significant from a technical standpoint. Thank you, Jeff, for that, sir. Thank you for everybody who is tuning in and commenting in the chat here. Now, I do want to zoom this back out to the weekly chart just to give you an idea of what we're looking at here. So we've breached this technical line here, the previous all-time high close for gold. And I've talked about this quite a bit on the channel up until this point. Now, I'm not taking this as a confirmation that we are breaking out of this pattern just yet. I do want to see a close above 2,100 bucks, so we got another $30 to go. But if we have another move up in gold like we had today, we will be above that level, and I think that'll be a very clear signal that the new bull market in gold is here to stay. If you want to stack some gold, you want to get your hands on some physical metal, SDBullion.com has got some great Cyber Week sales going on right now, and I know it's kind of tough to buy gold when it's at the highest price of all time. Of course, if you adjust for inflation, that's not quite the case yet. So $2,081 for an ounce of gold is a good deal in terms of the inflation-adjusted all-time high. But what really hasn't even started to move yet, in my opinion, is silver. So if you want to stack some of that, check out SD Bullion, channel sponsor. There's a link down below. And right now, you can get gold or silver at spot by visiting sdbullion.com/new. That is if you are a new customer. Now let's talk a little bit about Powell here. So a quote from Powell at this speech that he was giving at a university today, which seemed to be one of the catalysts for this move in the price of gold. He said, "It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease, but it doesn't look like markets are buying it based on the reaction that we saw today." Now, why is it that markets are convinced that the Fed will be easing sooner rather than later, and they are now anticipating rate cuts in March? Well, perhaps it has to do with this. This is a story from wolfstreet.com published yesterday. Unrealized losses on securities held by banks jumped by 22% to $684 billion in quarter three. And that's according to data released by the FDIC. That's a huge increase in one quarter, a 22% increase in the unrealized losses on these banks' balance sheets. And so certainly the Fed is paying attention to this. When you look at a chart of the unrealized losses, really kind of brings this into focus, what's going on here. And you can see, I mean, what happened was the Fed had rates down around zero for a long time. And in 2020, during all of the incredible stimulus, all of the debt buying by the Federal Reserve when rates were near record lows, the banks were loading up on these low-yielding treasuries. But surprise, surprise, inflation began to run out of control. The Fed had to embark on one of the fastest campaigns of rate hikes in history. And you can see what happened to the bank balance sheets there, a huge drop. Now, the only reason that we are not at record highs on these losses, on these banks' balance sheets, these unrealized losses, is because a lot of them have already been absorbed by the FDIC. So you can see that this is actually, the losses are slightly lower than they were back in Q3 of 2022, but that's because we've already had several banks fail earlier this year, and the FDIC absorbed them, sold off those assets. So those unrealized losses no longer exist because they've already been bailed out. But this is a trend that is likely to continue. Now, we've actually seen a bit of a decline in the yield on treasuries, which should give the banks a little bit of breathing room, you might think. But there's a couple of things I want to say about that. I mean, the first thing is, you got to realize why the yield on U.S. treasuries is coming down, because it's kind of a bizarre, paradoxical situation where the only reason that rates really are coming down is because either perhaps the Fed is out there intervening in the market and we just don't see it. I mean, that's just speculation on my part, though. Officially, they're still drawing down their balance sheet. But if that's not the case, this is just investors who are now convinced that the Fed will ease in the future and will return to easier monetary policy. But the paradoxical part of this is that when the Fed does that, it's going to drive inflation back up, which ultimately will lead to higher rates on these treasuries. So I don't think that the banks are out of the woods yet in terms of these unrealized losses. And also, you got to keep in mind that even though the yield on a 10-year is down from close to 5% down to 4.22% today, wrong story. Here we go. The purchasing of all of this U.S. debt on the part of the banks, it peaked back when rates were extremely low, much lower than 4.22%. So this is not as much of a relief to these banks' balance sheets as you might expect. And that's why I believe the Fed is going to have to intervene sooner rather than later. Now, I want to look at this chart here. You talk about value, and gold I still think is a good value, even though it just hit a new record price because, if you adjust previous all-time highs in gold for inflation, the price is somewhere around $3,300. That's using the CPI, so that's probably a low estimate for the all-time high of gold. So we're still well below the real inflation-adjusted all-time high for gold. But look at this chart. So this is gold up here, okay? Now, I've got two charts pulled up below that, two ratios. The first one, this is the ratio of the GDX, that's a ETF of gold miners relative to the price of gold. And you can see it has just been declining and declining near the lowest levels in more than a decade. And so, I think that the miners at this point are incredibly undervalued. I mean, my miners have been doing really well for the past couple of days with the rip that gold and silver have been on, but clearly there's still a tremendous amount of room for those to move higher. And then look at silver. This is the chart of the silver to gold ratio. A little bit different than the gold to silver ratio. It's the inverse. So, that's the one we usually look at. But this is silver divided by gold. And you can see it too is at a very low point on the valuation. Actually, the lowest point on the chart, with the exception of the incredible lows in silver that we saw back in 2020 when silver hit like $12. So, I'm a little hesitant to stack gold at these prices, but stacking silver still seems like a no-brainer to me, because once the bull market in gold really kicks off, and I mean, based on this chart, it looks like we might be right there. If we see a close above $2,100, I think it's going to be gold to the moon, or at least to that previous inflation-adjusted all-time high of $3,300 or so, so $3,000 plus gold. Silver's going to come along for the ride. And you're going to see this ratio begin to climb just like you did back in 2011. And I don't have the chart pulled up back to 1980, but this chart also moved up significantly in the precious metals bull market of 1980. So I think that this chart here shows you one thing: gold and silver still undervalued, and silver especially. Now, back to the miners. Got another sponsor for today's video, and this is one I don't think you want to miss. There's a free report you can access from Wealth Research Group regarding the coming bull market in gold and silver mining stocks. There's a link down in the description, and if you're watching this after the live stream is over, I will pin a link in the comments, but you can check this out with that link, and I think this is a report that all of you will want to check out. It's completely free and certainly worth a look, so check that out. Again, there will be down in the description and also in the comments pinned. Now, let's talk about the economic collapse, which is ongoing, which is likely to drive the Fed towards easing, because it's not just the banks that are suffering, although I do believe that that is probably where we will see the catalyst for a crisis, which will drive the Fed towards easing, and that is what will drive the Fed towards cutting. I mean, you heard Powell today. He said they're still ready to hike rates if necessary, but he did point out that they're monitoring financial conditions closely, and if we do begin to see a collapse, which we're already in the midst of, but if we see it become acute, that will cause the Fed to cut rates. It will cause them to come into the market and buy up the debt. Mark my words, I have no doubt in my mind that when we see this crisis really manifesting itself, the Fed is going to be printing like they have never printed before. And we got some economic data today which kind of confirmed that that is the trend we are headed towards. U.S. manufacturing mired in weakness, economy heading for slowdown is the headline from Reuters. And this is based on the Institute for Supply Management, ISM, manufacturing index, which came out at 46.7. That is below the expectation. I believe the expectation was 47.6. And anything below 50 on this index indicates economic contraction. So we're continuing to lose manufacturing jobs. We're continuing to add, what kind of jobs are we adding in the U.S.? Hospitality jobs, second jobs, third jobs, whereas real jobs that can pay for a middle-class lifestyle are evaporating, and U.S. manufacturing continuing to show weakness. Not surprising, considering the fact that the Fed is maintaining their tight monetary policy in an economy that is addicted to debt. I mean, the whole U.S. economy is predicated on easy monetary policy. The Fed kept rates for too low for too long. Now the whole economy is addicted to that, and it's a game of chicken here, basically. Inflation is still very high, but the Fed is going to be forced to cut. Despite that, I believe they will sacrifice the dollar to bail this system out. And just take a look at this. If you have any doubts that inflation is a persistent problem and that the Fed has not defeated it yet. This is from a couple days ago, a CBS study. Americans need to make an extra $11,000 in 2023 to keep up with inflation. So this was an analysis of government data which revealed that the average American household will need to spend $11,434 more in 2023 to maintain a standard of living compared to 2021. So in 2 years' time, the cost of living to maintain your standard of living gone up more than $11,000. And some people perhaps can absorb that. A lot of people can't. U.S. consumers are racking up credit card debt at a record rate. Delinquencies are on the rise. But even if you can pay that extra $11,000, just think about that. That's $11,000 that you could have saved. That's 5 ounces of gold, 6 ounces of gold you could have put away. Now it's just going towards basic necessities. Food inflation is out of control. Sure, the price of gas ticked down a little bit, but what did we hear from OPEC the other day? They're cutting another 1 million barrels of production, I think it was, in 2024. So, the price of crude oil, I believe, is going to continue moving higher. The ceasefire in the Middle East is over today, so expect crude oil to go much higher moving forward. That is my forecast. I mean, it's a volatile market, but I think in the long run, crude oil is going to be going much higher, and we're going to see inflation continue to be a very persistent problem. But the problem for the Fed is this. This right here. Unrealized losses off the charts. I mean, look at this chart. Does this look good to you? Look at how much the banks are sitting on losses. I mean, look at the losses. If we start seeing people pull their money out of the banks, it's going to create cascading series of bank failures. The Fed's going to have to get out there and print up billions, if not trillions of dollars to bail this system out. And if history is any guide, these periodic bouts of stimulus and easing that we get, they have to be higher and higher each time, right? Bigger and bigger each time. There has to be more debt purchased each and every time, which means that this next round of stimulus, this next round of easing is going to have to be absolutely gargantuan. And it may be the thing that creates a debt crisis and a currency crisis here in the U.S. I mean, look at this U.S. national debt, $33.8 trillion, no sign of slowing down. We're going to be at $34 trillion by the end of the year. We've already been told that over Q4 of 2023 and Q1 of 2024, the Treasury is going to be borrowing another $1.5 trillion. That's just what they tell you. I mean, imagine with the stimulus that is likely on the way, the wars which seem to be brewing around the world, which are likely to be very costly, the U.S. funding militaries around the world in their conflicts, providing personnel, providing training, providing arms. All of that's going to cost a lot of money. And the debt is just going to absolutely balloon out of control. And this ultimately is really the problem, is that the U.S. economy is addicted to this debt expanding at an exponential pace. And now we're at the point where if you break it down per taxpayer, we're on the hook for $259,000 each. So I don't know about you. I don't have $259,000 sitting around to help contribute to pay off this debt. And I don't think too many people do. The savings rate is near a record low. So what's the answer? Well, you got to print. You got to print a lot, and you got to print until the currency is devalued so that you can pay off this massive debt. Someone in this chat here says, I hope it doesn't go back down. Well, I kind of hope gold does go back down, to be honest with you. I think that we might see a little bit of a consolidation here. I think that the event which will actually catapult gold to, the $3,000 plus level, it will be when the Fed actually begins to ease. But I don't have a crystal ball. I mean, the move in gold and silver over the past several days has been pretty monumental. So it might not take that long. If we do get a pullback in the price of gold and silver, I will be very thankful for one last opportunity to snap some physical hard assets up at these ridiculously low prices, because in the long term, these prices are going away. Even in the medium term, as early as March or April of next year, when the Fed begins cutting, you're going to see huge moves in the price of gold and silver. At least that's how I see it. Let me know what you think in the comments down below. Thanks for watching, everybody. Do me a favor and smash that like button if you haven't yet. Subscribe to the channel and share this video on social media. Share it with your friends. Yeah, they might look like you're crazy, but listen, as gold and silver begin trending much higher, people are going to start paying attention. And the price of silver, especially right now, around 25 bucks. I mean, gold is taking out nominal all-time highs. They just took one out today. Silver is at 25 or at 50% of its all-time high. I mean, it's around 25 bucks. In 2011, silver hit $50, so we are well below nominal all-time highs in silver. And when you start talking about the inflation-adjusted all-time high, I mean, we're talking silver in the triple digits easily. So let me know what you think in the comments down below. Stay safe and happy stacking, everybody, and I will catch you next time